Thank you for tuning in to Investment Insight, brought to you by McCay Wealth Advisory. My name is Hayden Proffitt, and joining us today we have Brent McCay. Brent, bonds.
Yeah.
Bond market. Let's start with just the definition of what is a bond?
So basically a bond is where, you have two different types of investments, typically own versus loan. So own is where you own an investment, you own a business. Loan is where you loan money to somebody. So basically the bond market is the biggest market for investments. It's always funny, people think, hey, the stock market is where the money is. Well, bond market is multiples higher than the stock market. And so the bond market is where somebody, loans money for a certain period of time on an asset. If you borrow money for a car, you borrow money for a house, that money is secured by an asset. So it's considered less risky than an equity investment because you actually have an asset to base it on. Originally when I bought this building, the bank loaned me money for this building. And so then it was if I didn't pay, they come and
Take the building.
Right. So that's typically how bonds work.
Yeah, and there's different types of bonds, right? There's not just, bonds is kind of like a big umbrella, right? And there's different types of them. Just hit on some of them. Let's start with what's a treasury bond.
So treasury bond is where, you borrow money. The federal government goes out and borrows money, which means it's backed by the full faith and credit by the United States. If you read certificates, what's on the certificate. And so if the federal government wants to get money, they just raise taxes. They could sell some of the properties. A lot of people don't realize the federal government owns half the land in the western part of most states of the United States. So if the federal government really wanted to pay off some of its debt, or if they wanted to restructure those, they could go out there and sell a lot of that real estate. And there's actually a pretty strong argument that one of the reasons why some of that real estate market is a little expensive is because the federal government won't sell it. Because if they increase the amount of supply of real estate available, the price would then go down. And so the federal government basically loans money to, for myriad different things, to buy a bomb, buy a missile, do a grant for, let's say, COVID research or whatever. And so they'll go out there and go to the bond market, borrow money. The biggest buyer of treasury bonds is not China. It's actually your local bank. Banks are the biggest buyers of treasury bonds. So the biggest backers. And so your local bank is actually you. So you actually end up being the biggest creditor of the United States. And by the way, if they need more money, they come get money from you. So so really when you look at the treasury market, it's really valued based on the value of Americans. So.
Yeah, and do they have any taxable benefits or tax benefits?
So obviously our office is mainly based in Tennessee. We've got customers all over the country. And so one of the big benefits of treasury bonds is you do not have to pay state and local taxes. So I grew up in a group of Missouri in a city called St. Louis. Well, they have a state income tax and they have a city income tax. If I bought a treasury bond in Missouri, I would not be liable for the state tax or the local tax. Of course, seek out a tax advisor for your unique situation before making a decision, but that's how that law works.
Yeah. Okay, cool. And then so treasuries are another one. What about Ginnie Mae and Freddie Mac bonds?
So Ginnie Mae bonds and Freddie Mac are mortgage-backed bonds. Ginnie Mae bonds actually are federally insured. So what's different between a Ginnie Mae and a Freddie Mac is Freddie Mac and Fannie Mae are government agencies. So TVA...
Big distinction.
Big distinction because TVA, Freddie Mac, and Fannie Mae were the seed money to start those entities was started by the government. But if the government wanted to, they could let both of those go bankrupt. And they're not on the hook for it. Ginnie Mae bonds are actually backed by the full faith and credit of the United States. And so Ginnie Mae bonds tend to be more low-income housing, where if, hey, you invest there and somebody doesn't pay their mortgage, the government's going to write a check for it. They're going to pay, and so they're very, very safe, very, very low risk. Freddie Mac and Fannie Mae are a little different because they're government agencies, just like TVA is as well. And so they're paying mortgages, but if the government wanted to, they could just say, hey, we're going to let Freddie Mac go out of business, and then everybody gets to have to refinance their mortgage, which would not be fun. So that would be but that is a distinction.
Yeah, for sure. And then corporate bonds, like companies AT&T, McDonald's.
Yeah.
Bank
That's
of
basically
America?
it. So corporate bonds are where you're loaning money for Walmart, or let's say, if you look at Dollar General out here, Dollar General doesn't own any of these stores, from what I understand, very many of them. And so they actually go out and somebody else builds the store, and then that person, sells bonds or loans money against it to buy it. And so when you look at Dollar General, if they said, hey, you know what, we're just going to close the store down. They turn it over to somebody else. Well, the bondholder would still own that store or that asset, or Walmart or Apple. When they built their new headquarters, the big circle, people loan them money to do that.
Yeah, and with a corporate bond, you may lose some of the money, but not the entire investment if it should go under.
Well, you can still lose all the investment, but generally speaking, because it is backed by an asset, you've got a higher chance of recovering some money. But Treasury bonds are the safest because if you don't pay, the government can come in and they can take money, whereas a business can go under. And so, but they do have a higher, you have less chances of losing all your money than you would in like a stock.
Right.
But there still is a possibility that you could lose all your money in it.
Right, because a bondholder would be higher in the bankruptcy proceeding than a stockholder.
Correct.
So that would be one thing to definitely be cognizant of. And then municipal bonds, muni bonds, is there?
So muni bonds are pretty cool and they're very interesting. So like you think about, everybody's like, well, why do I need to know this stuff? Why do I care about bonds? And it's like, well, do your kids go to school? Because, recently when I looked at a Coffee County report, they had over $100 million in municipal bonds they had issued for the school system. And so when they build these new schools, when they build these ivory palaces, as I call them, those are pretty much funded by investors. And so one of the things that muni bonds are, generally speaking, not always, you have tax-free munis and you have taxable munis. So let me give you a difference. So if you're building a school, if you're building a sewer system, it tends to be tax-free. If you're building a stadium or something for an airport, something that generates revenue for profit, it tends to be taxable. So like the Cardinal Stadium, when it was built, was funded through St. Louis, but they were taxable municipal bonds.
Right.
Whereas, the sewer system here in Manchester is funded through tax-free bonds. That's a big deal for an investor. If you're an investor and you're in a 37% plus, or even if you live in California, if you're in a 50% tax rate, you might say, hey, I'm going to buy a California tax-free because if I'm getting paid 6% tax-free, that's worth more money than the stock market is because it's tax-free because you're actually bringing that home. And so municipals are really attractive for the tax-free nature a lot of times. And they're safe because, hey, if the sewer system gets in trouble, you still got to flush your toilet. You still want to have a shower. So the water department can always raise the fees.
Right.
Whereas if Walmart, stops making money, you can just say, hey, I don't need Walmart. I'll go to Dollar General. You can't really do that when you have a monopoly. And so a lot of municipal bonds have monopoly power, which means that typically I don't believe a triple or a double A bond has ever defaulted in U.S. history. And so they're considered very safe.
Yeah, and speaking of those bonds, how long is the typical duration? How long do they typically are held? And when at the end of a term of a bond, how much am I going to get back with interest being paid along the way?
So typically, if you buy bonds, munis are $5,000 increments usually, treasuries. I mean, everything's a little different. So you put in $10,000, let's say. You put in it, you can do 1 year. You can do whatever duration you really want to.
Right.
Everything's out there. And so obviously we're seeing some higher interest rates now than we've seen in the last 20 years. So there's some demand for investors to go longer term to try to lock those rates in because we all know we have a $33 trillion national debt. And so there's a strong possibility there that rather than raise taxes, they'll just print more money.
Yeah.
And by doing that, there's a strong chance that interest rates may be artificially depressed a little bit and let inflation run a little higher. So you can go whatever term you want. But generally speaking, if you loan money to Walmart for 10 years, you buy a $100,000 bond, and Walmart's still in business 10 years and they're paying their bills, you get your $100,000 back, plus you got all the interest payments for every year.
Right. And then with each of those types of bonds, right, the Ginnie Mae bonds, Treasury bonds, they're paid interest semi-annually or annually. How often are those paid in interest typically?
So it just depends. So there is no, really, everyone's different.
Right.
So-
They're not all the same.
So Ginnie Mae bonds, they actually pay back principal
Right.
while you own them. And so that's a little different about them is sometimes you get your payment, some of it's interest, some of it's principal. Most municipals pay on 6 months. Now, if you're going through the testing logic, they'll say there's a certain term, but there's a lot of different unique products that have different terms. So it just depends. Most people like monthly payers. A lot of corporates are monthly, but a lot of corporates are semi-annually too. So every bond kind of has a different cycle.
Right. And these bonds, they have an inherent market value about them as well. Because if bonds out on the street are paying 5% and mine I'm holding is worth 7%,
Correct.
mine's going to have a higher value because the ones that I can go out and get in the market are less than the one that I currently hold.
Yeah, so one of the biggest things when you're looking at bonds is the yield curve. So if you look at, if you're locked in at 5% and everybody else can get 7, if you were to sell your bond early, you would lose money. Or you wouldn't necessarily lose money depending on how long you had it, but you would get less than somebody else could get now.
Right.
And so when you look at bond ETFs or bond funds, where a lot of our investments are where you buy a blend of a bunch of different bonds that come due at different times, those values will fluctuate based on interest rates. And we've seen a lot of fluctuation with interest rates affect a lot of different businesses and a lot of bond holders lately. And so when you look at that is a component that will fluctuate. But here's the thing. If you own a bond and you hold it for 10 years, you're going to be fine. And if you're looking as a retired investor and you're just living off the interest and you're not necessarily buying and selling the principal, you don't have to worry so much. I mean, obviously your statement's going to change and you're going to see the valuation change, but bonds work the same way. As long as that company's in business, you put the money in. When it matures, you get your money back as long as they haven't defaulted. Most companies don't default, at least they haven't historically. And so you got a very stronger probability. And when they do default, you've got a secured asset behind it. But yes, interest rates will affect the value. If you're locked in at 7%, everybody else is getting 5%, you could sell your bond for more than you paid for it. Of course, the same token as you sell your bond, you pay taxes making money, you buy the next one at a lower rate. It's kind of like selling your house. You sell your house, you got to find another one.
Right.
Unless you're going to a nursing home or unless you're moving in with family. So if you look at that, it's not always the smartest move, because if you're owning a bond, most bond investors are holding it to get that interest check, to get that monthly payment when they're retired, to have that steady income.
Right.
And so that's what most people buy CDs or bonds for, and that's what we see here.
They're holding it to make money on the interest, right? That's
Yeah.
that's where they make their money, really. Because the principal investment is X dollars. You're mostly holding that because what's the point if it's different from your checking account? It's not getting interest.
Correct. You want the interest, and most people always want a steady income when they're looking at retirement.
Right. Absolutely. So, anything else to add about bonds? Or
That's really it. The big thing to factor into a lot of times when we talk about investments, the equities or the stock market gets the big attention, but the bond market is really where most of the money is. Most investments, even a large percentage of investments we do here in the office, are bond related. They're not as volatile typically, and they're maybe not as sexy to use that word, but they really are one of the biggest parts of an investor's portfolio.
Yeah, for sure. So, well, thank you so much for tuning in today to Investment Insight, and I hope you have a great day.